talking about Chapter 3. Now, what we're going to talk about in Chapter 3 relates to adjustments that we'll have to start creating. So far in this class, we've talked about various transactions that we journalize, and then we've learned how to record them, and then we've learned how to post them to various accounts and create trial balances. So we've come a long way. There are sometimes transactions we're going to need to create that we know we just need to do even though a certain economic event has not happened. That's what we're going to talk about today. Manners in which we have to adjust the accounts. So as we go here, we're going to kind of talk about various things. Net income. Net income, we know, is basically our revenues minus our expenses. But that difference, that net income, increases our owner equity, doesn't it? Our owner's equity. In the same respect, net loss decreases our owner's equity, doesn't it? Because that means our expenses are greater than our revenues. So with our net income, we increase our owner's equity. Revenues increase owner's equity. Expenses decrease owner's equity. So some concepts: net income is the excess of revenues over expenses. Revenues are monies coming in that increase the owner's equity. Expenses are resources that are going out that decrease owner's equity. And there's a new concept now called continuity. Continuity is the assumption that we will assume in the accounting records that a business is a going concern and will continue to operate indefinitely. So when we prepare accounting records, we don't go into it with the fact we're only going to be in business a month and gone. We go into it with the attitude that the business will continue in the near future. There's another concept called periodicity. That means that when we communicate this information, we communicate it in groups of periods. So when we report revenues over a certain period of time. So we come up with these artificial periods, accounting periods, call it a month, a quarter, or a year, and we create information for users in a period of time. Now, a new concept is called accrual accounting. We match the revenues to the period in which goods are sold or services are performed, and we match expenses to the period in which they are used to produce revenues. Accrual accounting is a significant piece of an accounting concept. Most of us, when we do our own income and expenses in our own home, we show revenues when we get the money. We show expenses when we pay our bills. But in accounting, the true method of measuring revenues and expenses aren't always when we get the cash, but when we did the job. Or expenses aren't always when we paid the bill, it's when the expense incurred. So we're going to talk about that at length today. Then we're going to talk about revenue recognition, meaning when do we decide we need to record revenue? Recognition, one example we've talked about already in this class, has to do with when we actually sell a product. Do we receive income from selling a product when we get the money? Or do we finally recognize the revenue when we ship the good? Remember how we would talk about transferring title? Remember that? Kind of? So that's a form of revenue recognition. When do we actually recognize a transaction as revenue? Do we do it when we get the money? Do it when we get off the phone right away? Or do we recognize that revenue when the goods leave the warehouse? Or do we do it when the title to the goods transfers to the buyer? Generally, that's when we're going to do it, is when the title transfers. When we're dealing with revenues, we recognize, when we're dealing with a service, we recognize revenues when we complete the job. So last week, someone came in for me to do their taxes. She handed off all the information, and she gave one of the girls in my office a check. Had I done the work? No, I didn't even cash the check until I knew I had completed the job. So today, I finally completed her tax return. Okay? At that time, I can recognize that revenue. I'm not just sitting with cash on hand because I haven't completed the job. So oftentimes, we recognize a service revenue when we've fulfilled our aspect of the job. Underlying concepts of income measurement. Net income is revenues minus expenses. And we want to match the revenues we earn with the expenses we incurred to make that money. So let's just say that we build a home. Let's just keep it simple. We're building a home. We build this home and we hire all these subcontractors to build the home. We're not going to record the sale of that home until we really have transferred title on that home. Okay? And we're not going to want to record all the expenses we've incurred in selling that home, like the fixtures, the cabinets, the wood, all the subcontractors, until we recognize selling the home. Because we want to match the revenue with all the expenses we incurred to make that home. See what I'm talking about? We want to match them. We want to keep them together in the same period. And along with this concept of measuring income minus expenses, or revenues minus expenses, is knowing that we will always measure this income in periods of time, called periodicity, or in a month or a quarter. And all of this is with the mindset that the business is going to continue on in the near future. Net income is the net increase in the owner's equity that results in company's operation, from a company's operation. In its simplest form, net income results when revenues exceed expenses. That makes sense. Revenues are 100, expenses are 70. What's the net income? 30. Net income's greater, or revenues are greater than expenses. Net income equals revenues minus expenses. But what happens now when expenses exceed revenues? Revenues are 70, expenses are 100. What do we have? A negative. So a net loss occurs when our expenses are greater than our revenues. You can't stay in business for long doing that. Revenues are increases in owner's equity that result from performing business activities. Those business activities can be hauling metal, 12,000 pounds of it in a truck so you can turn around and sell it. Or revenues can be providing services such as a tax return, or a personal trainer trying to get me in better shape. Or what else?
Plumber.
What?
A plumber.
A plumber to provide a service or install your faucet. Or a school that provides tuition and learning for you. So it's a service where you pay the tuition and you're taught something. Okay? All kinds of different manners of receiving revenues. Expenses are decreases in owner's equity resulting from the cost of doing business. Expenses can be things such as the salaries used to haul or to help you haul the wood, the metal. Expenses may be the rent I pay in order to house my CPA practice. The expenses for continuing ed can be hiring teachers, renting space, computers or technology they need to use to help assist in the classroom, the books they have to buy. All of those are various expenses in trying to make the revenue. Now, we'd like to say everything we do in accounting is perfectly straightforward and clear, but we do have some estimates we will create in accounting, such as we're going to estimate how long we think this projector is going to last. It might last longer, it might last less, but we're estimating it the best we know. Do you see how that's an estimate? Does that make sense? We're estimating how long we think this building is going to be up and useful. It could be, give or take, 10 or 15 years from what we're estimating, but we're doing the best judgment based on the information we have. So in accounting, sometimes we utilize estimates, and sometimes we have assumptions we make as we create financial statements. Assumptions made in measuring business relate to the attitude that we expect the business to continue over the near future. Another assumption we make is that when we record income, we're going to record it in groups of periods or time. Another assumption is that we want to match revenues we earn with expenses we incur to make money. So, when we talk about something called continuity, meaning that the business is going to continue on for a period of time, most companies present annual financial statements on the assumption that businesses will continue indefinitely. That term, that businesses will continue indefinitely, is called a going concern. It will continue operating indefinitely. Not every company is going to operate indefinitely, but that's the assumption we create when we create and present a financial statement today. The continuity assumption states, unless there's evidence to the contrary, the accountant assumes the business is a going concern and will continue to operate indefinitely. Now, generally speaking, that's a pretty good thought. How many of you guys remember Blockbuster? Okay? Today, do you see many Blockbusters out there? Why?
Red box.
They went bankrupt because of the red box, because of DVDs, because of Netflix. So, probably 4 years ago, if I would be doing a tax return for a Blockbuster, I may have concern it would be a going concern. Why? Technology. It's that simple, isn't it? Technology has changed so much that the chances of them sustaining their life without changing some type of technology is going away. How about payphones? How many of you guys ever use a payphone? Do you ever see them?
There's two of them I know.
Very seldom, but you see them. What's the problem? And people would get involved in all these buying payphones and utilizing them. What's the problem with that kind of business?
There's no need for them anymore.
You can borrow a cell phone.
You can borrow, I think with Obama you can get a cell phone now, can't you? So, certain businesses go away with time. You know those cash machines? I'll guarantee you in 15 years we won't see cash machines anymore. Why? We're going to become a cashless society.
No, bull.
Do you think bull?
They said that in the 70s.
We're getting closer. How about that?
We're moving toward it, but it'll be a long time.
Do you think it's a long time?
I mean, there's a lot of things that have changed over the past 30, 40 years, but I don't see us going cashless yet.
I give it 5 years.
No. It's going to be a long time. I do everything with cash. I refuse credit card.
prepaid card with, and nowadays, even your Apple phone, they can swipe it. It's almost scary, isn't it, what they can do? So that's up for debate another time, Fred.
I'll argue that.
Okay, we're going to argue it, Fred. But moving on, the continuity concept allows certain expenses and revenue transactions to be allocated over several accounting periods that we're going to talk about. That other assumption we brought up, called the periodicity assumption, states although the lifetime of a business might not be totally certain, it's useful to estimate the business's net income in terms of accounting periods. So we usually will say, well, my business this year had revenues of X. We usually don't say my business over the past 3 years had revenues of X. We usually keep it in terms of a year annually at a time, or a quarter, or a month. So that's the periodicity assumption. A 12-month accounting period is called a fiscal year. The fiscal year sometimes can be a calendar year, but a lot of times with companies, it's not a calendar year. Accrual accounting, another term for it, is called the matching principle. Basically what we do is we take revenues in an accounting period in which the goods are sold or services are performed. We also take those expenses to the accounting period in which they're used to help produce that revenue. When there is no direct means of connecting expenses and revenues, then costs get allocated among the accounting periods that benefit from the cost. Hang in there with me, guys. So, a couple concepts. Continuity, which is a business is going to remain as a going concern. We talked about net income. We talked about the matching principle, that we want to match the revenues we earn with the expenses we had to incur to get that money. Now we're going to start talking about cash versus accrual. The cash basis of accounting is the practice of accounting for revenues in the period in which cash is received, and for expenses in the period cash gets paid. That's cash. Most of us operate on the cash basis in our own homes. With this method, taxable income is calculated as the difference between cash receipts and cash payments. Right? Pretty straightforward, isn't it? But in accrual accounting, revenues and expenses get recorded not when the money comes in or the money goes out, but when revenues are earned, or with expenses when they're incurred, rather than just when we receive it or when we pay it. So, how do we decide when we earned it? That's what we're going to call revenue recognition, determining when we should record revenue. In order to record revenue, generally speaking, we need to agree we've got some type of arrangement. Then a product or service has been delivered, and the seller's price to the buyer is fixed or determinable. So, collectability is reasonably assured. So, for example, before any of this can even happen, we've got to have an agreement. So I'm hiring right now a new network guy. The network guy, or the internet guy, wrote my husband, emailed him last night and said, you know, I want to create an agreement that for $1,100 a month for the next 4 months, I'll on call, do whatever I can to take care of Nancy's business. Jim's trying to decide if he likes this deal or not. Jim says, yeah, it's okay for 4 months, but I don't want to pay $1,100 a month for the whole year when we really only are working for 3-4 months. So we're still trying to decide. Nothing's happened yet. Now he's come in and worked some, but we just haven't really come to an agreement as to how we're going to do it. So you first have to have some arrangement, right? Now I know and you know he's going to get paid, It's just a matter of determining if it's going to charge us by the hour or how this is going to work. Then, some product or service has to have been delivered. Now, he's already been at my office probably 8 hours working, so I know I owe him. Do you know what I mean? Because I've asked him to come in, I've given him the keys to my office, he has my security code, all my passwords. I know he's doing work. I've also created an exchange by handing it all over to him. Do you understand what I'm saying? We're still trying to determine the price. We're going to pay him by the hour or just a flat rate. And collectability is reasonably assured. So, if one of those is missing, then you're not going to have revenue. So, for example, dummy me had a client for a lot of years that was a painter corporation, and they filed bankruptcy. Usually people don't not pay me when they file bankruptcy if they want me to do their tax return. But he filed bankruptcy, and I did his return, and when he came to pick it up, he says, I'm not paying you. Well, is collectability reasonably assured? No. I don't have revenue then, do I? Did we have an arrangement? Yes. Did I deliver a service? Yes. Was my price determinable? Yes. But, do I expect to collect on them? No. No revenue. If you don't have all four of those, you're not going to have revenue. Expenses are recorded when all of the following conditions get met. There's an agreement to purchase goods or services. The goods have been delivered or the services have been rendered. The price has been established or can easily be determined. And the goods or services have been used to produce the revenue. That makes sense, doesn't it? There's an agreement. There's been an exchange. A price is known. And whatever those goods or services are, have utilized them to help produce money. The recognition of the expense doesn't depend on when the cash gets paid. It's that the expense has been incurred. So let's look at these four and see what we think here. 4 conditions must be met before revenue can be recognized. Identify which of these conditions apply in the following actions. Determines that the firm has a good credit rating. We're not going to do that.
Collectability is reasonably assured.
Okay, that's what they're trying to say. Okay, with the collectability, thank you. So, guys, I'm going to 10 steps here. We've spent some time talking about going through business transactions and then processing them and then recording them. Now we're going to do the same concept with what we call adjusting entries. From these adjusting entries, we're going to come up with a new trial balance and create financial statements. And so the key in this chapter is talking about what are adjusting entries and what do we need to do in order to provide these adjusting entries. So accrual accounting is all about adjusting entries. Adjustments are necessary because the accounting period ends on a particular day. So on December 31st of 2014, for a lot of businesses, the accounting period was over with. And based on that particular day, sometimes we have to do some adjustments to make their books accurate. Some transactions just span a cutoff point, and therefore some accounts need adjustments. When transactions span more than one accounting period, accrual accounting requires the use of something we call adjusting entries. So we're going to understand all this by looking at this business called Blue Design Studio and to figure out what needs to be adjusted. So here we have Blue Design Studio. It's giving us a trial balance. Now we know what a trial balance is from last week, don't we? It's just a list of all the accounts and the normal account balance. So if the normal account balance is a debit, we're going to put it on the left side. If the normal account balance is a credit, we're going to put it on the right side. And we know our debits have to equal our credits, don't they? So accounts such as assets. Assets would be, in this situation, cash, accounts receivable, office supplies, prepaid rent, and office equipment. Those are all assets. Assets always have a normal debit balance, which means they increase by debiting them. Then we have two liability accounts, accounts payable and unearned design revenue. Those always will have a normal credit balance, which means to increase their account, you would credit it. Then we have the equity section, or the capital, which has a normal credit balance, J Blue Capital. Then we see withdrawals, J Blue Withdrawals, is a normal debit balance. Then we show that our revenues increase our equity, or the worth of a company, and they have a normal credit balance. Then we've got a couple expenses that have a debit balance. So you see here, the total of our debits of $60,080 equal the total of our credits. They always have to. When we talk about adjusting entries, there are two types. One is called a deferral, and one is called an accrual. A deferral is the postponement of the recognition of an expense already paid or of revenue that was received in advance. So the cash payment or the receipt happened, but we haven't made the adjustment yet. In an accrual, we recognize the expense or the revenue, but hasn't been recorded yet in the period. So the cash piece of it's going to happen in the future, but we have to show either an expense or a revenue. So you've got deferrals and you've got accruals, and we're going to kind of go through what the two different ones are about. When you have an expense or a revenue, those items are going to be part of the income statement, aren't they? Expenses and revenues. The balance sheet is part of assets and liability accounts. So, depending on what we're going to do is based on what kind of adjustment. If we need to allocate costs between an asset or an expense, it's going to involve maybe 2 or more accounting periods. If we've got a liability and we've got to recognize unrecorded expenses, then it will be between a liability and an expense. We might also have recognizing unrecorded earned revenues, which will affect our assets and our revenues. Or we might have what we call unearned revenues, which is like a liability, and we might have to adjust them because we finally earned them. So we're going to just talk about all these different ideas. Allocating recorded costs. Companies make expenditures that sometimes benefit more than one period. So for example, we prepay insurance up front, okay? That prepaid insurance up front might last more than just 1 year or 1 month or one period. So when we make expenditures that are going to benefit more than one period, oftentimes what we do, we put it to an asset account that we call like a prepaid account. At the end of the accounting period, the amount of the asset that has been used up, gets transferred from the asset account into an expense account. So these type of prepaid expenses are those items that get paid in advance, but they've not been used up yet. So, for example, in a prepaid expense account such as prepaid rent, prepaid insurance, prepaid maintenance, what happens is we pay it up front and we record it as an asset. But then once a period of time has gone on, or we use up that asset, we're going to reduce that asset and treat it as an expense. So, here's an example of this. Blue Design Studio paid 2 months rent in advance at the beginning of July. The advance payment resulted in an asset, the right to occupy the office for 2 months. As each day in the month passed, part of the asset's cost expired and became an expense. By July 31st, 1/2 of the asset's cost had expired. So think about it. Blue Design paid 2 months in advance, or $3,200, okay? So 2 months, $1,600 a month. By the time July 31st hit, just due to the passage of time, we used up 1 month of rent, didn't we? So what happens here is our asset that we call a prepaid rent account over time is going to decrease. And instead, while that decreases, our rent expense account's going to increase because the expense is something that's used up in the current period. So, as you see, after 1 month happens, our prepaid rent account, instead of it being $3,200, it's now going to be $1,600, right? So let's look at this to start with. When we paid the rent for 2 months in advance, we debited prepaid rent, and we probably credited cash, didn't we? We transferred one asset for another. At the end of July, 1 month was already used. A month is worth $1,600. So at the end of that month, we're going to reduce our prepaid expense because we don't have it anymore. We're going to reduce our prepaid expense or credit it, and we're going to debit now an expense account because it's been used up. So do you see how we took it from an asset and we put it over to an expense? And all now we really have left is $1,600 in our prepaid rent asset account. So the journal entry we'll utilize to show that 1 month of rent has been used up is on July 31st, we'll debit rent expense for $1,600 and we'll credit prepaid rent for $1,600 because we don't have it anymore. We've used it up. So as you see here, the prepaid rent gets credited, it's getting reduced, and our rent expense is being debited. That's increasing. Here's another one. Blue Design Studio purchased $5,200 of office supplies in early July. At the end of July, an inventory shows that office supplies costing $3,660 are still on hand. That means that of the $5,200 of supplies originally purchased, $1,540 of supplies got used up. It became an expense. So we don't have that $1,540 of supplies anymore. Make sense? So we need to take a look, an inventory, and then make an adjustment based on that. So after looking at this, we know we need to reduce our supplies account and increase our expense account. Okay? It's used up. So what's going to happen now, our office supplies initially had a balance of $5,200. At the end of the month, we went in there and said, $5,200 we don't have. We have $3,600, $3,660. So we need to take the difference, the $5,200 minus that $3,660 left on hand, and reduce it by $1,540. If we reduce our asset by $1,540, we're going to debit our office supplies expense because we've used up that amount of office supplies. So the journal entry would be a debit to office supplies expense of $1540 and a credit to our office supplies because we don't have it anymore, do we? Are you guys following me? Here's another type of adjusting entry. When a company buys a long-term asset, such as a building, a truck, a computer, or store fixture, it's really paying for the usefulness of that asset for as long as it benefits the company. It's paying for it up front. Okay? So the accountant who's doing the books needs to find a way to allocate a portion of that asset over its useful life. So the way we allocate a portion of this asset, we call it depreciation. We take a cost of this asset and treat it as an expense each period. There are lots of different ways we can create depreciation. And we'll talk about that in time, but a lot of times we can do it a flat amount each year. A lot of times we can do it based on the number of hours that a piece of equipment's expected to last. Sometimes we can do it on mileage. I mean, there's all kinds of ways we can create it. But we've got to come up with a systematic method to record depreciation. But we want to keep track of, based on one specific asset, how much depreciation we've taken on that one asset over its life. So we're going to create an account that we call accumulated depreciation. It's not an expense. It's not really an asset. We call it a contra account because we use it to accumulate all the depreciation we've taken on one specific asset. So this contra account gets linked with an asset account. So, for example, if we have a piece of equipment and it cost us $10,000, and we keep track of our accumulated depreciation on just that piece of equipment, the difference is really what we're showing our net equipment to be, our new basis in it. So this equipment minus this contra account allows us to keep track of really what the asset originally cost and how much we've taken in depreciation over its life. That net difference between the initial price and all the accumulated depreciation is what we either call the carrying or book value of that specific asset. So here's an example. On July 31st, Blue Design Studio records $300 of depreciation of office equipment. So it purchased some office equipment and it's going to have a useful life of maybe 5 or 7 years. So Blue Design wants to allocate a portion of that office equipment as an expense in the current period. So what we'll do is we're going to want to increase our expense account and we're going to want to increase our what we call the contra account, which we would call accumulated depreciation. So the first time we do it, this is brand new equipment. We purchased it for $16,320. After we take our depreciation of $300, our new book value is going to be $16,020 because we take what we purchased it for, the initial cost, and we're going to subtract from it our accumulated depreciation of $300 to come up with what we call a new carrying value. So this is how we're going to show it on the balance sheet. How does this work? Our office equipment stays the full amount, $16,320. But when we take depreciation, we create this new account called accumulated depreciation on office equipment. We're going to debit our depreciation expense and we're going to credit our accumulated depreciation on the office equipment. And we're going to keep these two accounts kind of attached together so we know what their new carrying value is. So, to create that journal entry, we would debit depreciation expense, office equipment, and we're going to credit accumulated depreciation, office equipment. Okay? Now, at the end of an accounting period, some expenses have been incurred, but we haven't recorded them. So there are different kinds of expenses like this that have been incurred, but we don't record them. What about interest on a loan you have at the bank? You might have interest on a loan, and just because of the passage of time, you're going to be charged that interest. But we need to record it, don't we? We haven't paid it yet, but it's incurred over time. So there's certain types of journal entries we're going to need to show, such as interest. What about wages? What if the new period of wages started on January 28th? Okay, and the end of the accounting period is January 31st, but the wages aren't going to get paid till February 2nd. Don't we need to accrue those wages we've incurred in this period, but we haven't paid them yet? Make sense? Or sometimes we have utility bills that might happen too. These are all accrued expenses, but we haven't created a transaction to show they've incurred. So what's going to happen when we deal with wages, as you see here, is Blue Design has 2 pay periods a month rather than 1. So in the month of July, its pay period ends on the 12th and the 26th. By the end of business on the July 31st, which is at the end of the month, Blue's assistant will have worked 3 days. You see, Blue's assistant would have worked the 29th, the 30th, and the 31st. They'll have worked 3 days. The employee has earned the wages for those days, but isn't going to get paid those wages until the next month. So we need to show these wages, these 3 days of wages in July, as an expense for July, and the liability needs to show that the company owes those wages to its employees. Now, because the assistant's wage rate is $2,400 every 2 weeks, or we call it $240 a day, we're going to need to accrue those 3 days, the 29th, the 30th, and the 31st, at $240 a day, or $720 for the 3 days. So we need to find a way to show we've incurred those wages, even though we haven't paid them, but we owe them. So what happens here is we're going to increase an expense in this scenario, and we're also going to increase a liability. So in this instance of paying wages, we're going to call it wages payable. See, whenever it says payable, what do we know about it? It's a liability. The increase in wages expense is going to decrease our owner's equity ultimately because we're taking from it. And the total wages for the month are $5,520, of which $720 of that money is going to be paid in the next month. So you see here, we already had a wage expense of $4,800 for the month. But because we need to accrue 3 days of payments, we're going to show an adjusting entry of $720 as a wage expense, and we're going to credit our wages payable for $720. Do you see that journal entry there? Wages expense $720, wages payable is a credit of $720. There are more types. Actually, let's take a break and go through some problems. So let's take a break here and pull up the book And let's look at SE2. Should we look at SE2? SE2 says the prepaid insurance account, it's on page 110. The prepaid insurance account began the year with a balance of $460. During the year, insurance in the amount of $1,040 was purchased. At the end of the year, on December 31st, the amount of insurance still unexpired was $700. Prepare the year-end journal entry to record the adjustment for insurance expense during the year. So let's create a scenario so you can kind of see how this works. As you see here, we're going to start, I'm going to do a T account right here. We're going to have a T account right here. This T account so this T account is going to be called, what is it called? A prepaid insurance, okay? It told us we started with how much in it? 460. So as of, what day was it? The end of the year. So on 1/1, let's just say 2014, it started with 460. Then during the year, let's just say on March 1st, 2014, how much did we add to it? 1,040. Okay? So we've got our 460 plus our 1,040. And so what's our new balance here?
1,500.
1,500. It told us at the end of the year how much really was unused. 700. So guys, we know that our new balance really needs to be, new balance really needs to be 700. What is it we need to do to reduce this from a balance of 1,500 down to 700?
Credit 800.
Credit 800. So our prepaid insurance, the new balance or the unused portion should be 700, which means 800 really needs to be reduced, right? So what we would do there is we would debit an insurance expense of how much?
800.
800. And we will credit what? Prepaid insurance of 800. Does that make sense? Because we started with 460, we added to it 1,040, but then we go and look through our books and we go, wait, those insurance policies, we only have 700 still unexpired. So we need to adjust it and reduce our asset down to 700, and the adjustment really needs to be an expense now. It's no longer a future benefit, it's a current expense. It's been used up. It's no longer there anymore, is it? Make sense? How many of you guys are kind of following me? Let's do another one. SE3. The supplies account began the year with a balance of $380. During the year, supplies in the amount of $980 were purchased. At the end of the year, the inventory of supplies on hand was $440. We need to prepare the year-end journal entry to record the adjustment. So it started with $380, so I'm going to make this supplies, okay? It started with $380. How much did we add to it? $990? $980. So our new balance is $1360, isn't it? But how much is unused at the end of the year? $440 is our new balance. So we know that needs to be the $1360 we do show minus what they know is on hand at the end of the year of $440. That means we've used up $920, haven't we? So instead of this being called insurance expense, we're going to now make it supplies expense, aren't we? Supplies expense of $920. And instead of calling it prepaid, we're going to reduce it by just supplies. Does that make sense, guys? It's no longer an asset. It's been used up. So we have to adjust it accordingly, so we don't overstate our assets or understate our expenses. Okay? Here's another one. Is this helpful to go through these problems? Next, SE4. The depreciation expense on office equipment for the month of March is $100. This is the third month that the office equipment, which cost $1,900, has been owned. Prepare the adjusting entry to record depreciation for March and show in the balance sheet presentation for office equipment and related accounts after the March 31st adjustment. So we purchased this office equipment in January. So let's just look at this. We purchased this office equipment in January. So this office equipment we purchased for $1,900, right? And in January, what did we do with our accumulated depreciation account?
You subtracted 100.
In our accumulated depreciation account, we, in January, subtracted or credited 100. We did the same in February, didn't we? Right? Now it's March. We want to do the same in March, don't we? March. So our journal entry in March is going to be a debit to depreciation expense for $100, right? And our credit is going to be accumulated depreciation office equipment for $100, right? So look at this. Our accumulated depreciation as of the end of March shows $300. So if you were to look at a balance sheet, the balance sheet portion here, we would have office equipment of $1,900. We would have accumulated depreciation on the office equipment of $300 for the new balance on this office equipment to technically be $1,600.
Right.
Does that make sense? Yes, no? Kinda?
Yes.
Let's look at another one. SE 5, page 111. Wages are paid each Saturday for a 6-day work week. Wages are currently $1,380 per week. Prepare the adjusting entry required on June 30th, assuming July 1st falls on a Tuesday. So the work week is Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, right? And we're supposed to prepare a journal entry for the wages that were incurred on June 30th. Because they get paid every week. Saturday they got paid. So what's open here? What was incurred in June that we haven't paid for yet?
1 day.
1 day, right? So the 1 day that hasn't shown up yet is the wages expense for 1 day. The normal amount for a 6-day work week shows $1,380. So if we took $1,380 over a 6-day work week,
230.
it would be $230 is what we need to adjust for 1 day. So wouldn't we say in this scenario, wages expense of $230, and what are we going to credit? Payable. Wages payable of $230. Because we're not going to pay it yet. But we sure have incurred the expense, haven't we? Does that make sense, guys? Next. SE 6. During the month of August, deposits in the amount of $1,100 were received for services to be performed, but they haven't been performed yet. By the end of the month, services in the amount of $760 had been performed. So we had a deposit called Unearned Revenues that showed a balance of $1,100. Out of that $1,100, 760 of them have already been completed. So we need to prepare the necessary adjustment for the end of the month. So let's pull this up again. Let's look at this account, and we're going to call it Unearned Revenues, okay? Unearned Service Revenues. And what did it start with, guys? It started with $1,100. The balance was $1,100. The amount that had been performed was how much? $760. So we no longer have $1,100 that hasn't been performed. We now only have $340 that hasn't been performed, correct? Because $760 has been utilized. So in this scenario, what we're going to want to do is we're going to want to show unearned revenues, a debit of $760, and we're going to credit service revenues of $760. And this shows to record service revenue earned during August on which advance deposits had been received. questions on that? So we initially received the money up front, but we didn't do the work. So it was a liability on our books. Now, we did the work, so we need to take it out of that liability and show it as earned revenues or service revenues earned. Okay? Another one. Actually, I'm gonna